Okay, this video is going to talk about dividends. Okay, we have a share of stock here. This piece of paper represents an ownership of our business. And down here represents a check, and if we decide to issue dividends, this means we're going to share net income or profits with our investors. We would write a check for these dividends. Okay, let's talk about this. There are three important dates for dividends, and the first is called the date of declaration. This is the date that we declare our dividends, the date we're going to record our liability showing that we owe these dividends, and this liability is set up promising to pay our shareholders. And then the next one is the date of record. And this is the day that we stop the clock and see who owns our stock on this day. Whoever owns the stock on the date of record, these are going to be the people who receive the dividend. People are constantly trading our stock, so we have to set a date and a time to choose who's receiving our dividends. So if you hold stock on that date, you will receive the dividends. And the third one is the date of payment. So on the first one, we record our liability, and on the third date, we're going to pay that liability. Okay, so here's what the first one would look like. So on the first one, we're going to debit an account called cash dividends. And we're going to credit an account called dividends payable. So we're setting up our liability. And it would be for what amount we're paying in total. Let's say it's $100,000. All right, on the next date of record, there is no journal entry. This is simply telling us who's going to receive checks from us, who's owning the share of stock that day. Okay, and then on the last day or the third date, we're going to debit dividends payable because we no longer owe them because we're paying them. And we're going to pay out the cash. Okay, so let's look at these accounts. You're familiar with all of them except this account called cash dividends. This is a new account for us. What type of account is cash dividends? Well, first of all, it is a temporary account. And it's really comparable to owner's withdrawals. And the reason is because it is a distribution of earnings to the owners. The only difference here is the corporation has to decide to declare a dividend. The owners cannot choose to take a dividend on their own. But it is the same as owner's withdrawals. Okay, so it's a temporary account. And what I mean by that is it closes at the end of each period. The question is, what does it close to? If you remember how to close owner's withdrawals, remember we closed owner's withdrawals, usually the last step, and we would close it to capital. Well, now we break our capital into pieces. Remember the two pieces? We break it down into capital and into retained earnings. Well, we're going to close cash dividends to retained earnings. Remember, retained earnings is everything that we earned less what we distributed. Right here we are distributing our earnings. So that's where we're going to take it out at, and I'm going to show you what that looks like. So you're going to debit retained earnings, and you're going to get credit cash dividends, and this is how you close cash dividends at the end of the period. And the reason that I'm showing you this is because I want to show you the effect that cash dividends has on retained earnings. Retained earnings is a capital account and it has a normal credit balance. So it goes up with the credit. So I am debiting retained earnings. So anytime I issue dividends, paid cash dividends to my shareholders, I am reducing retained earnings, which is exactly what I should do because I am giving out some of my earnings. So it is reducing the amount of retained earnings or earnings that were retained in the business. So just to review, these are our 3 dates, and down here is how to close our cash dividends. And we will also talk about later stock dividends. So just note that these are cash dividends that will be sending out cash. And we will also talk about another dividend where we give out stock. So we will pay out a stock dividend instead of a cash dividend, but we'll talk about that later on. Let me know if you have any questions.